Today, we will talk about economic exposure. Economic exposure is when a company's future cash flows, foreign investments, and earnings are impacted by unexpected changes in currency exchange rates. This can have a big effect on a company's overall value and is a long-term issue. Companies can protect themselves from these changes by investing in foreign exchange trading. The amount of economic exposure a company has is directly related to the volatility of a currency. As the volatility of foreign exchange increases, so does economic exposure, and vice versa. The risk is particularly high for multinational companies that have many subsidiaries and conduct numerous transactions in foreign currencies. However, due to increasing globalization, economic exposure is now a concern for businesses of all sizes, not just multinationals. There are two ways to mitigate economic exposure: operational strategies and currency risk mitigation strategies. Operational strategies involve diversifying production facilities, end product markets, and sources of financing to offset the impact of currency fluctuations. Currency risk mitigation strategies include matching currency flows, risk-sharing agreements, and currency swaps, which involve borrowing each other's currencies for a period of time. For example, if a large U.S. company earns 50% of its revenue from overseas and the U.S. dollar strengthens instead of weakening gradually as expected, this represents economic exposure. The company would have to use currency risk mitigation strategies to protect itself from losses. One way to do this is by setting up an FX trading desk to help reduce exposure to adverse currency fluctuations. Economic exposure is managed through operational strategies such as diversification in production and markets, flexibility in sourcing raw materials, and diversifying financing sources. On the other hand, currency risk mitigation strategies include matching currency flows, currency swaps, risk-sharing agreements, and back-to-back loans. Currency exposure is the change in an asset's return due to fluctuations in a foreign currency when the asset's return is measured in the domestic currency. In general, it is the increase or decrease in an asset's value in the domestic currency due to changes in the value of a foreign currency, often measured in relation to a company's overseas profits that need to be converted back into its domestic currency. The main purpose of economic exposure management is to reduce the impact of exchange rate changes on a company's cash flows and to preserve as much foreign profit as possible when converting profits in foreign currencies back to the domestic currency. Here are 5 key takeaways. 1. Economic exposure is a type of foreign exchange exposure caused by the effect of unexpected currency fluctuations. 2. Exposure increases as foreign exchange volatility increases and decreases as it falls. 3. Economic exposure is a risk for multinational companies that have numerous subsidiaries overseas and many transactions involving foreign currencies. 4. Though economic exposure is a large concern for multinational companies, due to the advent of globalization, many businesses can experience economic exposure. 5. Economic exposure can be mitigated either through operational strategies, such as the diversification of production facilities, or currency risk mitigation strategies, such as currency swaps. Hope this would help. Thanks for watching.